Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. If I was to ask you, who is the punchiest of guests that we've had on this show, the most opinionated, who would you say?
There's actually two that come to mind.
Okay.
Yeah, one is Chris Joy.
Yeah. Okay.
And the other has got to be...
Oh, actually, sorry, before you say who we're actually speaking to, surely Matt Barry also gets it
Barry.
right.
The third is none other than Luke Laretive from Seneca Financial Solutions.
Now, Luke is probably best known for Pimp My Portfolio, who comes on and reviews the portfolios of Equity Mates community members, but he also runs Seneca Financial Solutions and runs the Seneca Australia Small Caps Fund. And he might be punchy, he might be opinionated, but full credit to Luke, he certainly backs it up. The Seneca Small Caps Fund is on an absolute tear at the moment. I think it returned, over 28% in the past 12 months.
Yeah.
And so we wanted to get Luke on to understand his process for how he and his co-portfolio manager, Benny, approach Aussie Smalls, what they look for, and where they find winners. And that's what we're going to be unpacking in today's episode.
Now, Ren, you've slightly undersold Luke there. It's actually 29.25% over the past 12 months.
Well, no, hold on. I said over 28%.
That is true. That is true. So technically correct there as well. 29.25% for the 12 months to March 2025. And it's also topping the list, the best performer out of a peer group of about 430 odd other small cap managers.
Well, if I undersold it, you certainly oversold it. So let's move on there. So in today's episode, we're going to talk about 4 things that Luke and Benny look for. And we're going to work through a case study, like one ASX listed company for each of these things. We're going to be looking at companies that are inflecting a profit turnaround, that have undervalued commodities, that have underappreciated growth, those that the market has fallen out of love with, and then have mispriced assets.
Luke has a stock picking research program. It's called Good Research. If you subscribe, you get 2 of his research reports each month, 1 company per report. They're companies that they're investing in or obviously are on their watch list, and some of the returns on them have been pretty amazing. Head to goodresearch.com.au. There'll be a link in the show notes. You can sign up using the code MATES to get 10% off.
All right. Well, with that said, let's get to our conversation with Luke Laretive, CEO of Seneca Financial Solutions.
Luke, welcome to Equity Mates.
I'm back again, boys.
You are back again.
Not sick of me yet. Not sick of me yet.
So let's start with the headline. Your small caps fund has been delivering 25% per annum since inception.
No, 25% outperformance in the last year.
Outperformance in the last year.
Yeah. Someone didn't read the briefing notes.
Did you read the notes, bro? Did you do any prep for these things? You're worse than me.
I guess, 25% outperformance in the past year. What have been some of the key characteristics of the companies within the fund that have led to that?
Benny and I ran the numbers. We kind of identified these 4 common threads, I suppose, running through our portfolio that kind of capture some characteristics with the companies that we're buying and why it's working. I think inflecting profitability, or businesses where they're not profitable but then they're becoming profitable or about to be profitable, improving free cash flow, that kind of thing. Businesses where growth's underappreciated, normally for some sort of emotional reason. This stock's been a dog, everyone's kind of discarded it, and now it's actually growing quite well, but everyone's not paying up for it yet because they're still skeptical. As you know, we invest in commodities and mining, and finding scarce commodities, undervalued mining companies has been, important to what we've done. So I think they're, the 3 things that have really driven most of the returns. And then another little bucket, it's smaller and kind of less relevant, is like mispriced assets. So kind of where you can buy, in our view, 1 + 1 = 3. The sum of the parts is less than the market cap, or more than the market cap, I should say. So that's been the 4 real parts: the undervalued sort of scarce commodities, the inflecting profitability, the kind of underappreciated, kind of unloved growth, and these mispriced asset opportunities.
So what we wanted to do in this episode is unpack all of those, because I think we can all learn stuff from each of those buckets. And we asked you to bring an example for each of them as well. So I think this would be a really good lesson for how anyone can invest in small caps. Maybe not deliver 25% outperformance like you, but we'll all certainly try. Let's start with inflecting profitability. So you kind of gave a bit of a description there, but like what are the key things that you're looking for? And then let's get into an example of it.
The high level origination of this idea is from, software as a service. You have a business where you spend a heap of money up front, and then you might be running for a loss as you're building the recurring revenue year after year, but it's, with low churn rates and consistent growth, eventually the revenue exceeds the costs, and then it starts to exceed the costs exponentially every year with the growth. And that's kind of been the core of the idea, but it kind of applies to any recurring revenue business where there's a high component of fixed cost. Yeah. So, we're going to talk today about RPM Global, RUL, which is a software business, but I don't think people should be just thinking this is a software or technology or sort of thematic. There's no thematic here. We're looking for specific sort of income statement identifiers, I suppose, and particular characteristics of a business from a qualitative assessment perspective that's driving these returns.
Before we get into the RPM Global, to, I guess, filter on this universe, is that what you're just looking for?
Yeah, I think the filtering is actually where everyone goes wrong, and the screening is where everyone goes wrong. So take RPM Global, it's a really good example to talk about why stock screening, the way that everyone does it, is poor and won't generate good outcomes. So if you screen RPM at a quant level, it'll look expensive and it will look unprofitable. And the reason why is because they don't capitalize their R&D expenses, they expense it. So if you don't have that understanding of the company or how they particularly treat R&D expense, particularly in software businesses, particularly in technology names, you're not going to be able to get to an apples and apples number that you can actually compare these businesses on. So if you're just relying on the numbers the company provides the ASX, and that the ASX then feeds to your Yahoo finances and your Google finances and all the other, unreliable sources that everyone relies on, then you're going to be screening out in opportunities, and typically you're going to be screening out the same opportunities that everyone else is screening out, and therefore missing the best possible investment ideas. So, I'm always banging on about the quality of the data that we look at, and how paying for high quality data is, a base, like that's your first port of call. If you're going to invest, you're going to make individual stock calls, even fund managers, assessing fund managers, if you don't have good database, like what are you doing? Like you're not going to be able to make a good decision without the available information as a bare bones basic.
For Bryce's point though, like let's hold on RPM Global for a second though. Like a classic example that we spoke about on the podcast recently is Catapult.
Yep.
Who are consistently, like the last couple of years, they've grown revenue relatively consistently, like double digits, just shy of 20%. But the thing that you like to see is that the losses are getting smaller. Like last year it was 19 million, this year it's 9 million. It's like that's kind of what you're wanting to see, right? You're getting closer to profitability.
Yeah, if you do it on the NPAT basis though, like if you're looking at it like the losses getting smaller in the business, you're going to be pretty late to the party. You're going to be buying Catapult at this result or the previous result. You could have really picked up what was happening on Catapult probably 3 results ago. And how you could do that is by, you look at follow the cash, follow the money, follow the cash flow. So that's how we found Catapult at $2.
So cash flow turns before net profit after tax.
Yeah, you start to see it on a month to month or quarter to quarter or half to half basis. You can see that the cash flow is building. It might be negative still, but it's building and it's creeping towards profit, breaking even and then making money. Yeah. I think in software, because of, and I mean in other businesses too, because of the accounting treatment of those non-cash items, it can be tricky to rely on NPATs. It's why we spend, probably you look at more like EV to EBITDA ratios and these sort of things in those industries, and you save your NPAT ratio for a bank or, your PE ratio for a bank or something that's more relevant on that basis. So I think, Cat's been great for us. It's been great for Good Research subscribers, and it's been the second biggest holding in our fund for God knows how long now. It's been an important part of the driver. I just didn't want to cover it today. I could easily do that for inflecting profitability as well. I just didn't want to cover it because I know you always talk about it. And
it's been good for me as well. Let's talk about RPM Global. So for people who aren't familiar with the stock, what does it do?
Yeah, they have essentially 30 odd pieces of mining software that they kind of aggregate in a single platform, enterprise kind of platform that, you know, a BHP or a Worley or a Hitachi can buy. So, you know, they service mining companies, big mining companies. They service the mining services providers to those companies, the contractors, and then also the sort of large OEMs and equipment people, fleet guys to help them manage fleet. So they have a range of products, probably 3 or 4 of them are kind of the main ones. But the main story here is it's a software business with subscriptions selling into enterprise customers, not B2C. It's sort of a B2B world. And this business does, you know, near enough 100% subscription revenue now. Nice. So 99.7 in the first half. So it's growing that revenue at 18% CAGR over the last 3 years. And we think they've got scope to increase that growth rate as well, or definitely maintain it. But talking to the Inflecting profitability, we've seen EBITDA growth now 49% for the next. So you've got a company that's doing 18% headline growth, but profits are now growing at 49%, and we think they might do 35 to 40 in 27. Wow. So, you know, there is significant, you know, in fund manager speak, operating leverage here, but that's just inflecting profitability for the average person. It does look expensive when you screen it because of this conservative treatment of their R&D expense, because everyone else capitalises on these guys' expense, or most others capitalise at least partly. But when you adjust for that, RPM's on 21 times, doing 40% profit growth versus ASX sort of tech peers on 35 times doing 20% profit growth.
So that's interesting. So you say it's on 21 times, I assume next year's earnings?
Yeah.
Yeah, because if you just look at like the Google finance...
It's going to come up like 60.
No, 97.
Yeah, exactly.
Yeah. So you're saying that, and obviously that's trailing, not next year.
Correct. And it's also assuming... like you've got to back out all of your development costs. Essentially.
Yeah. So you're saying that big difference is just explained by those two things:
Correct.
Trailing versus next year, and the R&D costs.
Correct.
Yeah. Okay.
At what point do you get out of these stocks?
It's a good question. So, when we think the valuation is pricing in a future we don't think the company can achieve.
Yeah. So okay.
That's pretty much the. You know, if you think about a basic PE ratio, essentially it's just saying, well, I think the company can earn this level of profits for this many years. So if the PE is 10, it's saying, well, the company earned $1 in profits. It can earn, you know, I'm happy to pay $10 for it because I'm certain that in 10 years' time, it's going to be still earning $1 in profits, and I'm going to have received all of those $10 of profits. So you just got to think about the future and what the future is realistically going to look like, and what these businesses can realistically achieve. And if you think that the market's being unrealistic, do something about it.
So the second bucket is underappreciated growth stocks.
Yep.
You've brought one. What is it?
Energy One.
Okay.
EOL is the code.
So you explained it a bit before that this thematic is like a dog of a stock, your words, not mine. But it's like something that's been unloved, or it's let investors down.
Yeah.
Or and for that reason, people don't rate it as it turns around. Is that a fair summary?
I mean, like Catapult would probably straddle both these buckets. It's probably a good, good for the audience who knows. You know, Energy One have had a few cost issues. They've had a few missteps over the journey, but not so much recently. But they have a great product operating in a really good market and performing really well. So they run, you know, what we always describe as like the Iris or Bloomberg terminal for energy traders. So it's a piece of software for energy trading, risk management, and market ops for wholesale electricity markets, and it operates in Australia where it's got 50% market share, and it's also expanding to Europe now where they've got 20% market share, 90% recurring revenue, 20% per annum growth, 70% held by insiders and founders, diversified customer base where they've only got no customers more than 5% of their business, and they work with the likes of like, you know, AGL, as well as like the generators, as well as the traders and the smaller utilities as well. So it's a really good business, and sort of despite being up, I think it's up like 30% since we wrote it up for good research in March. It's up over 300% since we first bought it for the Small Companies Fund. It's just a really good quality software name. Doesn't trade, it's not very liquid. Yeah, so it gets avoided, I think, by some fund managers for that reason. But you've just had, you know, you're seeing all of the what I would call like the late to the party small cap fund managers now coming into it, the Wilsons and the, like it's the normal, like, and all the ones you all know. And so, for us, we think this still has a fair way to go. And the reason why is, it's only on 22 times EV to EBITDA, which, is that's a spicy multiple. It's not, out of context. But that's still a 30% discount to Gentrack, which is its nearest peer. That's GTK code, and that's on 32 times. So when you look,
which is bigger, market share wise.
Gentrack's a bigger business.
Okay. Yeah.
But if you look at say like Rule of 40, so that's the do you guys know about?
It's like revenue growth plus profit margin needs to be above 40 for
correct
SaaS companies.
Yeah, so you're a cat shareholder, you'll be ramping that down your throat. So
Zero was pumping it.
Zero as well. Zero are big about it. Yeah. So
hey, we host an investing podcast. We know a thing or two.
You're improving. It's a rule. Every time I see you, you're improving. I'm slowly influencing you. Just So no, Energy One's doing 25% EBITDA margins and 17% revenue growth. So they're hitting Rule of 40. Gentrack's also kind of almost there as well, doing 14 and 25. So I would argue that if it is a Rule of 40 business, and if we talked about, anything else, you would say, well, 35 times is kind of where these things typically trade. These, recurring revenue, high quality software businesses. Gentrack's on 32. I could go through. They're all pretty much. They're all there. Zero's on 35. So I think this kind of goes to those multiples, and that's going to lead to a pretty healthy gain even from $14 a share.
So you said that all the Johnny-come-lately fund managers are getting in on it, and if you look at the price chart over the past 12 months, it's up more than 200%.
Yeah.
So, but you still think it's got further to run?
Yeah, I think. Yeah, I mean, we bought it under $5, and we still own it. I don't think we've sold probably like 10% of our position size, not much. So we sold a little bit, but like
because if this is underappreciated growth, it feels like looking at that chart, it's starting to be quite appreciated.
It's getting more appreciated, but I think that you need to. Someone smart in the markets once told me, always remember just how early you are. So like, I think in our industry, especially when you find stuff that no other fund manager owns, that you're pretty much first to at the moment, or in this particular part of the cycle, you're never first to it, but do you know what I'm saying? You're relatively new to it, and you think just because it's done well, you get this sort of compulsion to sell it. You're like, oh, well, I want to sell it here. And even like Catapult, it's probably like it's a common example I'm relying on but I know that you know it so well, so it's sort of an easy one. Is it unrealistic to think that can get to 10 times EV to sales? Is that really a stretch? I'd argue probably not. Is 7.5 times that it's on at the moment a bit more than what I would ideally like to own it for? Yeah, probably. But everything's kind of tracking in the right direction and it's doing all the things it's supposed to do. So it'd be a pretty brave fund manager to be like, yeah, I'm happy to sell here, or definitely sell all my position here. You might want to sell a handful. I think EOL is kind of in the same vogue. It can run for a lot longer, and you've got that valuation anchor there where you know that if it's going to hit Rule of 40 for 2 or 3 years, it's going to end up at 35 times pretty much. So if it does that, it's going to be $20 plus. So I think when you've got that tailwind from the transition to renewables, you can't just EOL software essentially allows renewables to be able to interact in the most efficient way with the grid. As they're managing their own load and the loads of the grid, it's doing that work for them. So they've got good tailwinds as well. There's no real reason to think things are going to go skew-if here. So, you can invest with a degree of confidence, I think.
Before we move on to the next bucket, I've got a stock that I think loosely fits underappreciated growth. Definitely inflection, profit, turnaround.
Yep. Oh, a Bryce stock.
I'd love to hear your thoughts. I'm pretty sure I know what you're going to say, but Zip.
Luke was taking a drink of water as you were saying that.
Out across
I thought he was going to spit take. Yeah.
Because for me, like
anyone who knows me knows I love, like I made a lot of money out of Zip, right? Like I pretty much, my net worth is a lot to do with buying Zip at a very low price. So I like the business, the people, or the old people anyway. I don't really know the new people, but I haven't owned it for a long time, right? So my view on that industry, probably more broadly, is that the returns aren't as good as everyone thought they were going to be in terms of, you know, revenue yields and the cost to run these businesses and the marketing spend per incremental sale. So do I think these models can be tweaked to be more profitable? Yes. Is it recurring revenue? No, it is not recurring revenue. So I don't think it is, you can't bank on the revenue line.
Yeah.
You might, and I think what you're underappreciating as well is how much they spend trying to hit that revenue line. And if they don't achieve it, they've spent that money anyway.
Yeah.
So, you know, if you're paying to market something and then you don't get the sales and you've got wafer thin margins to mess with, you're going to inflect the other way. And as Benny and I, another good Seneca quote or whatever you want, aphorism is, you know, operating leverage works in both ways. So, you know, don't get it twisted. Just because something's got momentum and it got operating leverage and this profit's inflecting, it can also do the opposite if they have a period of, you know, elevated costs and or reduced revenue growth.
Nice.
Well, 2 down. We've got 2 to go. Luke, let's talk about undervalued commodities. Well, let's start with what you're looking for here, and then we'll get into the company that you think illustrates it.
So, you know, scarce commodities, a lot of people don't invest in mining. A lot of people don't invest in commodities. When you talk to fund managers, they'll say, yeah, we're a small cap investor, but we don't invest in resources for whatever reason. I think that's a bit of a mistake, because we live in Australia. You're an Australian fund manager. You know, I don't know what the percentage is, but it's high of GDP comes from the mining and energy sector.
Your WA roots are showing.
Well, I think it makes sense.
No, you're right.
Whether I think Western Australia should, you know, separate from the rest of Australia and become its own independent country, that's a story for another day. But I do think that there is a lot of opportunity in that space, and I think there's a lot of fund managers who just pretty much put it off to one side, or they do it, but they do it so poorly that there's a lot of opportunity for investors to make money here. So it's been a good hunting ground for us. You know, we've been on the silver thematic earlier in the year. You know, I think we've owned some really good gold stocks. We've played gold really well this year. I love our copper exposure at the moment. I think that, you know, we're going to go through a period of risk on in the market from this period of risk off, and that risk on period is going to see a rotation out of, you know, the gold sector and gold prices continuing just to exponentially go up. I'm not saying they're necessarily going to come down a lot, but not exponentially go up further. And we're going to start seeing some of these pro-cyclical commodities start to come back, and that's going to be good for a lot of companies on the ASX.
What's your favourite copper play?
I think AIC Mines up in Queensland, really good management team, done it before with Evolution. Good assets. Everyone's a bit skeptical on it because it's deep, but these guys know how to do deep. I think it's the cheapest exposure by a country mile. I'm pretty sure Matt Copper got a takeover bid this morning. I got a text message before.
We haven't let you look at your phone.
No, yeah. I've done I did 37 pimp my portfolios prior to this, and so I think that that's going to be a big story, and I think energy in general. So whether it's oil and gas, lithium, thermal coal, I think that sector also has a lot of tailwinds, because if you look at the US gas prices relative to those on a kilowatt adjusted basis, the prices are high and everything else is cheap, so that won't last forever.
Where's our good friends at Antipa up to?
The great Antipa resources. So Greatland Gold have announced that their prospectus is out now for the ASX. They're doing a
So they can't go with a bid now though, right?
Yeah, didn't they need to do the acquisition before they put the prospectus out?
I think they probably should have done it before the prospectus, but I don't think it necessarily means they don't do it soon.
Sorry, we should just say, for people who are unfamiliar with the Antipa Minerals
maybe
saga,
Bryce could give it a rundown.
Oh yeah, what do you remember?
Yeah, let's go.
Okay, so way back February, I was trying to turn $500 into $5,000. Still am.
Are you still doing it?
Yeah.
Oh. Sorry, maybe just focus not on you, but focus on the company.
Okay, me time for Bryce.
And of course, the first person I call for some inspiration is Luke, through good research, your stock research. And Antipa was the first. And it was because we were going for companies that we believed would get a takeover offer.
And the stock price when we talked about it was?
Stock price, I got in at about 21 cents.
Yeah, it was, I think, it was under, we bought it for 2 cents, but they've done a reconstruction to 1 for 10. So,
yeah,
20 cents.
Now.
Yeah.
Anyway, long story short, it is a like a gold pit.
Yeah.
And it's right next door to this Greatland Gold processing facility.
Yeah.
They they are looking to list. You reckon they need more input through the processing facility, and this pit is sitting right next door, untapped, very cheap, and you think it's a great opportunity for Greatland to come along and buy Antipa so that they can get some gold through their processing
Mate, you've actually done a really good job. I'll fill in the gaps if you want me to.
Before you fill in the gaps, I just want to close out the Bryce 500 to 5K story, because since you bought it at under 20 cents, it's now 60 cents.
I know, so yeah.
And you haven't 3x'd your money.
No.
So
why have you not done that? Is that because
I tried to
you're an
leverage
idiot.
triple
That's
long.
Yeah.
The
and
NASDAQ,
did that work for you?
I've tried to overdo it. I was looking back. Yeah, I made about 50% on it, 54, 55% on it. Got out, tried to play the Trump Liberation Day, and have now
did
looked
well
back
and
at
then
it,
got fisted.
And I would be.
What do they say? Overtrading is hazardous to your wealth.
Yeah,
Classic example.
and I'd be sitting in about three times up.
And it's a bit like this is probably off topic, but more ideas isn't better. What's better is one great idea. Is better than 10 average ones. So
I was thinking about it, reflecting on it yesterday though, when I was looking at my portfolio, being like, "Fuck, I need to do something about this." And if it'd be so classic. First investment we make in that, and we're just sitting 300% up.
Yeah, I mean, it would have been really good for you and the segment. Look,
anyway,
I'm sitting here like,
I know.
I'm like, hello.
All right. So now you were going to tell the rest of the Antipa story.
Oh, okay. So we'll fill in.
Long story short, it hasn't happened.
It hasn't happened yet. Takeover hasn't happened yet. We've still made a lot of money. But Greatland Gold's, £1.7 billion market cap. They have acquired this mill, which has got 20 million tons per annum of throughput. They're using like 10% of it. They reckon they're going to be their Havieron asset doesn't come on for a couple of years. They've got this like 3-year gap where essentially they reckon they're going to be able to explore at Telfer, which has been mined for like 50 years, and as Newcrest and everyone else ripped all the gold out of there. They reckon there's going to be more gold there. I don't think there is. That's my view. And I don't see why at a 350 mil market cap or whatever Antipa is today, you wouldn't just lob a script bid at 550 or 600 mil market cap, offer for them there and say, yeah, dish is done. And now you've got an extra 2.5 million ounces straight into the thing. The market's going to ascribe a bigger premium to Greatland Gold because it's got more assured production from a lower cost source at higher grades and putting more out every year in production. Like, they're going to make it back in multiple within a week. So, in my view, it's an absolute no-brainer. I don't know what the BD team at Greatland Gold are doing.
They're obviously not listening to this podcast.
Like, they are asleep. And I hope, they do it, because Antipa in its own right is probably worth like $1 billion. They build a plant, get into production, expand. They've got some really good exploration ground as well that they're doing quite good work on. So if that happens, say it's worth 800 mil conservatively, right? On an MPV basis, no risk, just raw numbers. Well, that extra 500 million is pretty much if they build a mill. If they don't build a mill, it's probably worth like 2.5. So all that value just goes straight to Greatland Gold shareholders because they've already got a mill with excess capacity that could more than process the ore. So anyway, look, I think it'll happen in due course. It might not happen today. I don't see how it doesn't happen if Greatland Gold does well and their share price keeps going up. They might want to get this IPO out of the way first and then do it. They might want to wait a year and see what Antipa is, see if they can get a bargain. I don't know.
Are there rules around when you lodge a prospectus, you then can't go and buy another company or anything like that? No.
Really? You see a amended prospectus all the time.
Yeah, okay. Yeah.
So, look, I'm not sure how it plays out. I just can't see any other logical outcome here. That's going to maximise value for Greatland Gold shareholders. Okay, I'm going to make some money out of it, talking my own book, 100%. But
So
It makes too much sense.
the interesting thing there is like we introduce this as undervalued commodities, and people often think about like the commodity that a mining company is extracting. But in this case, like the undervalued commodity is more like its location.
Yeah, it's the strategic nature of some of these assets.
Yeah.
We can look at something like an AIC Mines versus a Mac Copper versus a Capstone. They're trading at big discounts with better growth, but they may be just less well known. They're just less, don't have a famous, mining geologist as the CEO.
Well, I mean, you kind of tipped your hand earlier on what AIC, because the ore is so much deeper that
they have these little
undervaluing
little
it
things.
They think it's going to be harder to extract.
Correct, and people apply. I mean, particularly generalist fund managers apply these rules of thumb to the different that they've picked up over the years. And it's, as you guys know, it's normally in the assumptions is where you make the money, right? Like that, or lose money. It's because of your assumptions. And I think because of these general concepts that people apply quite indiscriminately, a bit like stock screening, like we talked about earlier, indiscriminately doing things, not actually doing the work, not actually being an expert, you miss stuff.
Yeah.
And eventually it comes back to bite you on the bum.
I mean, I feel like we're talking about 4 ways to find great stocks, but really the one thing that ties them all together is like deep understanding of the company and its like specific people and operations.
And you cannot have deep understanding of a company if you don't have good data. Whether that's good qualitative data from the business, good qualitative data from their suppliers, their customers, the channel checks that we do, good quantitative data, and not just in share prices and trading volumes, but accounting things as well. So, and then have some sort of concept of understanding of those data points so that you can adjust and accurately compare and contrast.
Yeah, and it makes sense because like if the data that we're getting from like Google Finance or whatever has the information we want in there, then like the quants will move faster than us. They'll find it faster than us and they'll execute on that trade faster than us. It's like the example you gave around like not capitalizing your R&D expense. Like they're the things that like the quant screens will miss.
Correct. And they're the things that you're not betting against Renaissance. Like it's it's, and people say, why isn't Google right? I don't know why Google's not right. Like it's just not right. The number's not right. People get dividend yields out of the back of the paper still, like on the, no, they do, like, no, but to be fair, and it's like, you guys watch like one more planet. It's like last year's dividend, who cares?
No, to be fair to Google, the numbers are right. They just don't tell the whole story. It's not like they're misreporting.
No.
It's just that, like, in this case, the accounting treatment of one specific line item is different, and that then leads to a different, number that's spat out. Yeah,
and I just think, you need to understand a number's only a number. Everything needs context.
Yeah.
And that's the grey. That's where the money is.
So the fourth bucket is mispriced assets. So the example that you've brought is Neuron Pharmaceuticals, NEU.
Yeah.
So talk us through it.
Anyone who knows me knows I hate investing in pharma and biotechs and drugs. It's really, it's a.
Ben said the same and then gave 2 biotech stocks.
Yeah, so Benny and I, we own these 2 biotechs at the moment. One of them's Neuron, right? And if it goes wrong, I'm going to feel like an idiot. But and I'm going to be like, why did you do that? But I think I'm right, and it's working at the moment. So we'll pretend like we're gurus at the moment. But like, okay, so they've essentially, the long story short here is, they've got a good drug. Dabu, this drug, it's for rare neurological disorders, Rett syndrome, and essentially it's got rare drug designation in the US, and means they can charge essentially whatever the fuck they like for it, right? And then they have this second candidate, NNZ2591. Let's just call it NNZ for short. That's going towards phase 3 trials. The market is ascribing no value, in our opinion, to that second drug. So we feel like we're buying a business here with Dabu worth $10 a share in North America. It's worth $4 a share for the rest of the world stuff that's going to do.
Just to be clear, Dabu is the first drug.
Is the drug. DAYBUE.
I don't think we introduced that. Yeah.
So drug number 1 we think is worth $14 a share as it is. Stock's trading at, I think, like, I don't know, $16 a share or something. I can't remember. It's gone up a little bit the last couple of days. So, it's a lean company. They run essentially out of a home office. There's like 20 staff here in Melbourne. They sell via essentially a royalty deal with a distributor, Arcadia, over in the US. So very leveraged, capital light business model. Fine the way it is. So if asset 1's worth the current market cap of the business, when you add back the cash as well, we think that they're is a non-zero chance of that second drug getting approved, in which case we're getting like a free call option. And on our assessment, kind of based on phase 3 trial success and blah, 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 some work we did, we think there's another $15 a share potentially available to us on a risk basis.
Why is the market getting it so wrong then?
Because the market is skeptical, and people are overly skeptical, overly conservative, because they get paid a very good salary to be right. And when you're paid a really good salary and you've got 2 kids in private school and you don't want to lose your job sticking your neck out making calls, you don't make calls and you don't take risk, and you do things that are certain and known and defendable.
So it's not that they just think this drug's a flop though?
They might. Some people will. And they might. And our view is that it might be a flop, and in which case, cool. I'm underwritten at $14.
Well, yeah, I mean, the stock is trading on a 12 times multiple at the moment.
Yeah, it's cheap.
Yeah.
So the scary thing here is if we say blue sky upside case and we unrisk our numbers, so we say that drug gets approved, I think it's like $30, $40 a share. So...
Mate, you need that for your 500 to 5K. No, phase 3 will take
it's also,
the
reason it's on 12 times is it's in like the catalyst desert at the moment.
Yeah,
it's in that period of time. They've got money, they've got cash, they're not going to do anything, but just nothing's going to happen.
Yeah.
So, you're going to really not going to see the outcomes for 12 or 18 months.
What is the timeline on it, do you know?
I think it's going to be longer than what your 500 to 250 challenge is going.
Well, I mean, phase 3 trials can last years.
Yeah.
Look, this is going to be a next year probably story.
So if that's the case, why do you hold it? Why do you hold it?
Because you're not going.
Because you've always been one to say as well, you want every dollar working for you.
So as time gets closer, I mean, we saw it with, this company is not like Opthea at all. It's much more like Telex than it is like Opthea. But, Opthea, I think 4x'd before it even got into the trial. So the markets typically start to speculate on this as the trial gets closer. So if you're waiting to be closer, you're going to end up paying overs, and then you're not going to be then you're not underwritten anymore. And you're going to be paying more and more over $14. So at the moment, you're only paying $1, maybe over $14. I mean, we've got it for less than that. But the point is that at the price now, you're pretty much underwritten by the existing drug, and you're getting all the blue sky for free. As you start to pay more and more and more, creeping into the valuation, paying for the blue sky, you've got more at risk.
Yeah.
And so that's why you would buy something like this and you would own it now. And as other people want to speculate on it, maybe I'll be selling into them. And I'll be reducing my phase 3 trial risk.
It does contradict some of the stuff you say though, which is like, like if it sits at 14 for like 2 years, there's an opportunity cost for that money.
Of course there is, but
so you wouldn't want to sell, buy something else, and then buy back in when it starts to make its move.
Yeah, but I think you don't know when it starts to make its move, and you certainly you don't have that level of precision.
Yeah, that's
I don't really have that level of precision. I wish I did. I think. Again, it's a really good example of the importance of a portfolio of things. You can afford to own things at lower weights without them having to have a catalyst next week.
Yeah.
And you can average into something over time and still end up with a really good average price but you picked up some of your weights, like some of your portfolio weight later. So it's also about portfolio construction. This isn't like a 10% position in our fund at the moment. Antipa is. Catapult is.
Next time you do a Pimp My Portfolio and a audience member has a stock that's a bit boring or a bit nothing, I'll say, remember Neuron?
And I'll be like, it's $40 a share. Cheers.
Yeah. So those are the four, I guess, things that you're looking for, or things that have delivered that value over the past.
Yeah, they're four of the tools. Like we've got other tools in the toolkit, but in the last 12 months, they're sort of when we do our attribution and we look at our data and we say, hey, we put through every trade we've done for the year, what's worked, what hasn't. Critically analyze ourselves, critically analyze the decision making and the thought processes that go into making those trades. This is what has been working and been the real drivers of our performance.
Nice. Well, Luke, I'll finish with a softball. If anyone wants to invest with you, what's the best way to do it?
Love a softball from you,
I
Ross.
guess what's different about your setup compared to some of the other managers?
Okay, so well, for starters, the Seneca Australian Small Companies Fund that we're talking about today, it's open for wholesale, sophisticated and professional investors only. So you need to go and get a certificate from your accountant and send that through. Yeah, it's only open to wholesale, sophisticated and professional investors, and it has a 0% management fee. So there's no management fee. We don't charge people if we don't make them money. We charge a 20% performance fee for any returns above the RBA cash rate. We offer monthly liquidity. So, on the first of the month, you can buy and sell. We invest in anything on the ASX, long only, no leverage, no thing funky, no hedging, no nothing, just buying stocks.
Why did you choose the RBA cash rate over the small caps index? Small cap index is probably doing worse than the cash rate at the moment.
It is, and the reason why is because we think that you can be in as long as you've got a high watermark, it means that you're aligning your incentives with your customers. It also, for us, when we had a look at the fee structures of doing a management fee with a small ordinaries performance fee hurdle, it comes out about the same over a 5 year, through a cycle. So, we would much rather just be charging when we're making people money, and then the months when the market's down, you're not paying.
Now, if you can't get in or don't want to get into the fund, but you still want to get access to Luke's stock picks, Good Research might be something that interests you. It's Luke's and Ben's stock picking subscription service. 2 stocks a month, under the radar ASX companies, expected returns over 20%, limited to 200 members. As I said, 2 stocks straight to your inbox with all of the research every month.
I mean, it's the same. It's literally the same work that we do in-house that Benny and I use to pitch stocks to each other. All we do is just tart it up for punters so they can read it and make sense, and it's a bit more logical and easy to read. And then we whack it on a PDF, and you get one every 2 weeks.
Yeah.
Energy One's on there. RPM Global's on there. Neuron's.
Antipa
If Neuron's not on
there.
Neuron's coming down the pipe. Antipa was on there.
PointsBet.
Cat's on there. PointsBet's on there. Like, there's been GDC was on there. There's been lots of good winners on there.
There have been. So check it out, goodresearch.com.au. If you use the code MATES at checkout, you'll also get 10% off both the monthly or the annual subscription. So there's not a whole lot left.
I think there's 75 subs left.
Yeah.
Well, Luke, as always, pleasure to chat.
Yeah, thanks, boys. Really happy to be here.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.